Welcome to this presentation, the United States Macroeconomic Facts and Outlook. I'm Anthony Miller from APM Sovereign Risk Analysis. Enjoy. Hello, welcome. In this presentation, we will provide an analysis of the U.S. economy from the perspective of Austrian macroeconomics. This way, we will detect features that usually are neglected. So it is not just a common macroeconomic analysis, but one which is based specifically on the perspective of Austrian macroeconomics. Thank you very much. Talk about the U.S. economy is the relentless rise of the U.S. stock market, here in this graph represented by the Standard & Poor's 500. It is parabolic, an exponential rise, and we can be pretty much sure that this cannot go on forever, particularly when we enter a phase where it's almost vertical. So this cannot happen. So we have two problems to address. How was this possible? And second, why it cannot go on. Why was it possible? The answer is that since the early 80s, when we had a peak in the interest rate, here the 10-year US bond yield, for a very long period, practically until last year, we had a decline of the interest rates. But as you can see, this trend was broken recently. And now the big question arises, will there be a new trend to higher interest rates, or will we go down from here again? So this is the questions we have to ask, and I try to answer it in this presentation. Another important fact is the US dollar exchange rate. Here we have the following phenomenon. In the long run, we have a declining value at the exchange markets of the US dollar, with amazing volatilities, with huge shifts and also rapid and immediate returns. So we have spikes. This is a typical thing to consider. Nobody knows when such a spike will come, and it is a complete reversal of the few years before. Now we have this long trend downwards, but about since 2010 we have an upward trend of the US dollar, and here the question arises whether this is a new tendency to new strengths and continued strengths of the US dollar, or it will come to another downward fall of the exchange rate and to take up the old established trend basically since the 1950s. Another important fact is the moderate price inflation that we have had over a long period. Not only that the inflation, a little bit more down, the price inflation was relatively low, amazingly low, it was also so that with a few exceptions, the volatility was very low. So we have low price inflation and low volatility, quite different from the period before 1980, where we had a rising trend of the inflation rate and high volatility. So the question is this now the period of this low inflation, low volatility to continue? Or is this the exception and we will come back to some kind of new inflation trend, or maybe even to deflation? So this needs to be examined also. Then we look at the US Central Bank balance sheet, which explains a lot. We've had a gigantic rise in the creation of money, more than 8-fold increase that we have had. And so when we go further back, it was much lower than here in 2008 when the great reversal began. Yeah, so we have all those, we have this pattern up and then smoothening up and then trying to moderate and then strong move again, and now we have a decline here. So the question is, will this downward trend continue of the restriction of the money supply, or will we resume again for kind of some external factor or whatever, and the US Central Bank will continue a policy that basically started in 2008. Now coming to the US, have a look at the annual GDP growth rate, and we notice a very positive picture overall, with a slight tendency to have lower growth rates in the long run, but we are mostly in positive territory. The recessions were relatively small and short. Of course, we had this big downward movement and the COVID crisis and a strong recovery thereafter. So we know the reason for this fall and spike. And here we have the financial crisis of 2008. So all in all, it is a positive picture, but we have to notice that a long-term trend is moving to lower real economic growth in the United States. And there are no reasons to believe that this trend could be broken soon. Now look at another relevant figure, the GDP per capita purchasing power parity. And we clearly see here this steep upward trend till about 2006-08. Then the financial crisis, and then we have to go on a lower trajectory. So we are at a lower trajectory now compared to if we had to continued on the older trend. And the question now is whether the US economy will come back to the earlier trajectory, or it will fall down again on a lower trajectory. So this is a difficult question, but we have some ideas for some forecast about that. A lot depends, of course, on the US savings for capital formation. And here we have this long-term trend of a declining gross savings rate, which has been compensated for some time by a huge import of foreign savings. Now, after 2010, we had this breakout to a higher level, but we can be pretty much sure that will be a reversal to the trend again in the future. So when foreign savings no longer enter the markets, and there are many indications for that, the savings rate in the US itself is too low to maintain capital formation. Here we have the slide on the fixed capital formation, and here we have this earlier trend till 2008, and then this lower trend. And up to now it looks quite good. There is enough foreign capital still entering to compensate for the lower domestic gross savings rate, but will that continue? And another very important phenomenon that you could say, okay, these high valuations of the stock market are justified because the labor productivity. Here we have an interesting trend that the earlier trend since the end of the 1940s was broken in the end of the 1990s, and we are now on a trend to higher productivity. So if this should continue, and this is the big question now, we are in terrific territory. And in fact, the high valuation seem partially justified, albeit they may be actually right now exaggerated. But this is the important question. Will the US economy continue on this amazing path to higher productivity? And here comes an important caveat. If we have this higher productivity, shouldn't there be deflation in the US? Simply put, if a business produces at lower costs because of higher productivity, prices should fall. Now, there comes the point that this immense rise of productivity led the US central bank to expand its money supply, and this higher money supply did not show up in higher inflation rates because of the productivity. Okay, here we have a first weak point that I ask you to reflect upon. So, when productivity continues at this steep path, well, inflation may not show up, although deflation should be required. If, however, this trend stops for whatever reason, and there are many to mention, then the US monetary expansion has exaggerated the economic growth, and we will have a strong reversal to the established older trends. One fact that also gives rise to concern is government spending. So we have a long-term trend here to rising government spending, and this of course cannot go on, and it is well known that the new government that will start in January 25 will try to reverse this trend, which is of course necessary. If we should continue and move back, we are going towards a situation as we have in Europe, and certainly a way when the productivity rise will stop. And we have another fact for concern, which is the government debt, which is now higher than during World War II. So we have this immense government debt to GDP at a time when there's basically no hot war, where the economy is relatively doing well. So what will happen if things will turn out bad because of serious international conflicts and a recession? So by any means, government debt is too high. Now, one of the positive factors of the US in comparison to the European countries, the government payroll has not increased drastically. This is a good sign. So, okay, the government is still contained in the US, different from European countries, but the debt level is too high. The money expansion was too large, giving the productivity gains, which would have required a deflation. Now we come to the external sector, and here the outlook is not so great, and the facts are disturbing. The US has a high ongoing current account deficit due to a negative trade balance. Now, this cannot go on because it comes along with higher external debt. The trade balance is negative, amazingly negative since the 1980s. Before that, it was quite in a balance. So we have a new period here, let's say 1982-83. And the trend here is horrible. So this cannot go on. And the government knows it. Whether this policy of imposing tariffs is the right way, I doubt so. But this is another question. So other factors should here be the concern, which basically is an overvalued exchange rate due to the international position of the US dollar. We will address this problem in another presentation. What does this mean and why is it precarious? It is precarious because the US net international investment position is not only in a downward trend, but here we also have a negative exponential trend, and this cannot go on. And the foreigners note it, and the BRICS nation try to change this orientation towards the US. They are no longer willing to finance the US debt by exporting their national part of their national savings, and then in the US this imported savings allow domestic capital formation. Now the federal debt held by foreigners has been steeply rising, quite for a long time already, but steeply since the turn of the century, and this upward trend is also unsustainable. Now, what is the outlook? Let us have a look at the rating agencies, what they say. Have a look at the ratings. Standard & Poor's has stable, and DBRS has stable, but Moody's outlook is negative, and recent S&P assessments also point to negative. So what is our assessment? We offer specialized reports for the following categories: stock market, government bonds, direct foreign investment, and political risk. For prices and conditions, send your inquiry to apm.sovereignriskanalysis@gmail.com, and I will give you an offer. We can prepare specialized reports. To conclude, the US economy has been on a fantastic path. The stock market valuation seem from this perspective justified, but a fundamental error is in place. So we have had amazing rise in labor productivity, a new trend, an amazing trend, which, if we had non-interventionist central banks, would have led to deflation, a beneficial deflation. The central bank used this productivity gain, similar as it has happened in the 1920s, to offer an immense amount of money creation, which impulsed the boom, which created the bond bubble and the stock market bubble. And in the meantime, the US government accumulated excessive debt at home and abroad. So our outlook is negative, still stable, but it will turn negative, because we see no way how the incoming government could, with this policy of protectionism, improve the situation. So if you want to know more, please write me an email and we will prepare a report. Thank you very much.